Welcome back. On day one of the Trump administration yesterday, Trump did not announce 25% tariffs on Canada, as previously indicated, but later in the day suggested those tariffs could come as early as the 1st of February. My next guest says the threat of tariffs has wreaked havoc on metals markets, among other things, leaving traders scrambling for clarity. Joining us in the studio to talk about it further is a longtime expert in this field. Bart Melek is Global Head of Commodity Strategy at TD Securities. Bart, thanks for coming in.
Oh, great to be here.
How does this look to metals markets?
Well, it looks uncertain. I think, that's probably the kindest and mildest thing I can say. Recently, we had a so-called blowout in EFP, exchange for physical and silver and gold markets, and that was all because markets were concerned about what tariffs might be. And at this point, we're not looking at global universal tariffs, though apparently that may too be coming, as was said in the Oval Office the other day. Right now, I think the focus seems to be Canada and Mexico. But it's not only the metals market; it's also the energy market, which would be much more important to the broad economy than just the metals market itself.
What does Canada's metals trade look like with respect to the United States? A company like Teck Resources, for instance, produces significant amounts of copper and zinc in British Columbia. How much of that do we know goes to the buyers in the U.S.?
I don't have the exact numbers, but we are a big exporter of zinc. I think that may very well be one of our largest sources of metal exports directly in U.S. Certainly is a big customer of it. What would it mean? Ultimately, there aren't that many substitutes. You can, maybe get it from Chinese smelters instead. You can get it from, Canada. Ultimately, it means broadly higher prices domestically in the U.S. and then, some sort of market segmentation, a global price and a U.S. price.
Back to the oil market, what do you make of this? So much has been talked about since the threat of tariffs first emerged. The fact that we are a major supplier of oil to the United States. They really depend on our oil for a whole suite of refineries in the northern part of the United States. Where do you think this is going? Well,
look, ultimately, I don't think the Canadian oil can be easily substituted away. No matter what some politicians may claim south of the border, the reality is the United States imports some 4.5 million barrels of crude from Canada. Most of it is heavy crude, which not only produces gasoline, but produces heavier fuels, other byproducts that are necessary for industrial uses and, transportation of industrial and commercial goods. The reality is, even if you retool those refineries, which would take a significant amount of capital, it would take significant amount of time. America doesn't really have the heavy. You would have to bring it either from Venezuela, and Venezuelan industry is not exactly producing at all cylinders. You would have to maybe bring in heavy from Saudi Arabia or somewhere else. And, that begs the question, why target Canada when you're going to have to replace it from foreign product somewhere else? So sweet crude isn't enough for it. And there is a lot of logistics that would have to be reshifted. So it's a long-term phenomenon that would have to occur. And I think in the short run, it means because demand for oil is so-called price inelastic, U.S. would most likely eat most of that 25%, in essence, higher prices.
And so you don't think tariffs are going to apply to Canadian oil, do you?
I think it would be unwise to apply a tariff on imported crude in the United States, since the United States still consumes a lot more than it produces, though it produces a lot more than it has historically.
What about the metals that we had a story in our newscast about the lithium market and the EV mandate being rolled back, for instance? What effect do you think that might have on the lithium market?
Well, look, ultimately, any time you increase the price of a good domestically, you will have less demand. Something like lithium is probably a lot more elastic than oil. We still have very few substitutes for energy coming from crude. Meanwhile, if you're using the lithium for something like an EV, I have other substitutes for it. I can have, an ICE vehicle instead. So I think it wouldn't be accretive for prices broadly.
Might this affect the precious metals market at all, like gold, silver, platinum?
Oh, I think so, but I think, in a different way than many expect. So if we do see, these broad tariffs against commodities, against manufactured goods, ultimately I equate that to a negative supply shock. In essence, aggregate prices, take a lift almost immediately. Some get fully paid by the U.S. consumers. Some of the incidents of these tariffs get passed on to the producers, but overall prices move higher. Now it depends, what is the Fed going to do? If the Federal Reserve accommodates this shock, in essence, it gets worried about negative impacts on employment, and it, let's say, lowers rate a lot at a time where you have inflation from these tariffs, you could have a bit of a early 1980s, 70s phenomenon where you have a supply shock from tariffs, and then you have monetary policy that accommodated it, and then we have an inflation problem, and probably not only in the United States but globally.
Is this the biggest commodities story in 2025, the Trump tariff threat and how it plays out around the world?
I think it could be. We'll see what happens. He will apparently have consultation. The other, of course, big one is the weak performance of China. And that certainly was the big story before tariffs and before Mr. Trump won the election, which I think for the most part was unexpected.